Markets rise, markets fall, but have you ever noticed how some sectors crash much harder while others barely move? Why do some stocks drop 30% while others hold steady? And most importantly, how can you, as an investor, spot these trends before they happen? Take a look at this chart. It shows how much different Nifty indices have fallen from their 52-week highs. Some have held up well, while others have completely collapsed. Let's break down what's happening and what it tells us about the market. Let's start with the broader market. Look at the Nifty 50. It is down about 12.7% from its peak. Not a small drop, but not disastrous either. Now, compare that to Nifty Mid Cap 100, which is down 18.5%, and Nifty Small Cap 100, which has lost almost 22%. That is nearly double the fall of large caps. What this tells us is that the sell off is hitting smaller stocks much harder. This isn't surprising. When markets turn volatile, large caps are seen as safer and money moves out of mid caps and small caps first. These stocks tend to be more liquid on the way up, but also more vulnerable when sentiment reverses. This is exactly what we are seeing right now. But not all sectors are falling equally. Now, focus on Nifty Realty, down 28%. This was one of the hottest sectors last year, with stocks running up massively. But real estate is extremely sensitive to interest rates. When money was cheap, these stocks surged. Now, with higher borrowing costs, demand is cooling and we are seeing a reversal. The same thing is happening in metals. Nifty metal is down 20%. Metals are cyclical, meaning their fortunes depend on global growth. When the economy is expanding, demand for steel, aluminum, and copper rises. But when growth slows, these sectors get hit first. There's been a talk of US tariffs affecting India's steel and aluminum companies, but India barely exports steel to the US, so that is not really a factor. Now I want you to focus on PSUs. Nifty PSE is down almost 30%. But unlike metals and reality, this isn't just about economic cycles. PSU stocks saw an insane retail driven rally over the past year, especially in railway stocks. The narrative was strong: government capex, railway modernization, infrastructure spending. Retail investors piled in, pushing valuations to levels that made no sense. And now we are seeing the reversal. This is a classic case of FOMO driven rallies ending in sharp corrections. The stock didn't fall because their businesses suddenly got worse, they fell because they ran up too much too fast. This is exactly why investors need to separate market hype from actual value. Spotting these trends early is what makes a difference between chasing momentum and making smart investments. That's why I break down market insights like this regularly. If you're finding this useful, make sure you subscribe to the channel and join the Telegram group where we discuss market trends, sectoral movements, and deep dive research. The link is in the description. Now let's shift our focus to the sectors that have held up relatively well. Why? Look at FMCG, down 8%. Why? Because FMCG is a defensive sector. Whether the market is up or down, people still buy soap, toothpaste, and groceries. These businesses are stable, their earnings don't fluctuate wildly, and that is why their stocks tend to be more resilient in corrections. Private banks have also held up better, down just 10%. Compare that to PSU banks and you see the difference. Stronger balance sheets, better asset quality, and lower government interference means private banks are less volatile. This is exactly why they tend to do better during market stress. And then there is Nifty 100 low volatility, which is down only 13%. This index is built for times like these. Investors rotate into lower risk stocks when uncertainty rises, and that is why low volatility strategies are outperforming right now. So, what can we learn from this? First, momentum rallies can unwind fast. The biggest gainers of last year, reality, PSUs, and metals, are now leading the fall. Second, defensive sectors protect your portfolio when market gets volatile. FMCG, private banks, and low volatility indices have held up far better. And third, liquidity drives markets. When conditions are good, small caps and high beta sectors rise the most. But when risk appetite drops, they are the first to fall. This is exactly why understanding sectoral trends is very important. If you can spot which sectors are overextended and which are defensive, you can make better investment decisions and avoid getting caught in a brutal drawdown. But here's the thing: just because a sector is falling does not mean that it's not worth investing in. There are always great opportunities, even in a weak market. Sometimes great companies get dragged down along with an entire sector, and sometimes a beaten down industry is actually set for a turnaround. The key is deep fundamental analysis, understanding which companies are genuinely undervalued and which ones are just falling knives. That is exactly what I cover here, breaking down not just which stocks are moving, but why. If you want to learn how to analyze markets with a long term perspective, make sure that you join the Telegram group and follow along.